Let's dive deeper into the action with the markets reporters. Renita, what are you watching?
Caroline, I'm taking a look at a couple of metals which have been roiled as investors digest mixed economic signals. We're talking about those stronger numbers, or weaker numbers rather, from manufacturing, as well as labor market strength. Now, gold slipped by more than 0.5% during the session, nearly heading back toward those July lows, and copper is also lower, seeing its lowest since around August 5th. But analysts say that the market's paying less attention to metals, more attention to the Fed and Jay Powell's speech on Friday in Jackson Hole. Abigail?
Well, Renita, I am thinking about stocks and bonds. Stocks, of course, you go into for growth, or that's the logic, the thinking. Bonds are going to go into for yield. That's not really the case right now. Stocks are actually yielding more than at least the 10-year yield, not surprisingly, with it at 1.61%. This chart goes back all the way to the Great Recession, and it is the difference between the S&P 500 dividend yield and the 10-year yield. So in the green, the S&P 500 is yielding more. So you see during the recession, investors going toward those defensive sectors such as staples and real estate that Caroline, Taylor, and Romaine were just talking about. And then when stocks are doing really well and promising, we see that the bonds typically will yield more than stocks as investors go toward the more growthy sectors such as technology. That's been the case for most of the last 10 years. But right now, Taylor, Romaine, we do see that we have the S&P 500 yielding more than bonds.